Hello, this is Joe Boston with the Dallas Real Estate Investment Group, and I'd like to welcome you to the Real Estate for Life podcast, where if you tune into us, you're going to be learning a lot of different aspects to what we're doing, not only in the Dallas Fort Worth area, but also we're going to be talking about things that people are doing nationwide. So, one of the things that I wanted to highlight is what are some of the other exit strategies as well as techniques that you could utilize that you might not have thought of. And also, you might not know who are out there doing it in the marketplace. And so, we were fortunate enough to actually develop a relationship and find a gentleman that specializes in mobile home parks. And I am so excited that Mario Dattilo is with us today because not only does he do this for a living, but also he teaches people how to do it. And I've had a lot of people ask, you know, what can we do in a down market when we call them stick builts? When there's just nothing that you can actually buy that's affordable. And a lot of times over, the last, I'd say 20 years for me, we've actually run into people that are actually buying and selling mobile homes themselves, but it always seemed like the mobile home park was out of reach just because we didn't know anyone who was doing it. And so we were fortunate enough to have and kind of search out someone who was doing it. And Mario, I'm so glad to meet you, and also have had conversations with you. And I'm looking forward to sharing, what we can learn about the mobile home industry and how you can help our viewers and our clients possibly pursue doing this for a living. So, welcome today.
Thank you. I appreciate you having me on, Joe. It's been fun. We've been talking for months now and kind of getting to know each other and finding out what you're doing in Dallas. And as you know, I love Dallas. I actually own assets in Dallas Fort Worth market. So being able to do this with you is a pleasure of mine too. I love helping other people learn this industry because most people aren't talking about it, like you said. So thanks again for having me on. We're going to have some fun today and give a ton of value to the listeners, regardless of where they're at in their real estate investment career, whether they're ready to buy a park today or they're interested in single family. I'm going to make sure that this is beneficial to you guys, regardless of what you're doing in real estate, I promise.
Well, that's good. So, for most of us, we learn our real estate journey from single family. And, that's just the natural progression of how most people actually learn because they typically will live in an apartment and or own a single family residence. And some people, yeah, they might have lived in a mobile home, and that's possible. But what I find is that most people, not their natural progression is to go single family, then multifamily, right?
Right.
Which they go, oh, we want one roof with multiple, doors instead of having single roofs, right? But it's funny how, when you actually can look at a mobile home park and you can actually go, this has almost all of these aspects within one environment. It's almost like your own kingdom,
Yeah.
So what makes it unique? What do you think makes mobile home parks unique?
Actually, that's a great point. Mobile home parks are probably one of the most unique asset types in the real estate world there is. And what I mean by that is if you look at our business model as kind of two different, it's more of like a hybrid business model because we've got lot rent, making us kind of like a for-profit homeowners association. I always say we don't own the homes, we own the land and the infrastructure. The residents own their homes, and then we have the ability to enforce, them paying the rent. We have the ability to enforce them maintaining their yard and their home, but we don't own it. If they default on one of those, we can evict, obviously renovate it and sell it. And it allows us to basically be the landowner and the land, manage the land basically. So that's the homeowners association side of it. And then if you look at it, we're also kind of a hybrid with a builder developer model as well, because anytime we have a vacant lot, we bring in a home, we set it up, we get it ready to go, we market it, and we resell it. So we've got like a rental model with a sales model sitting on top of it, making it very, very unique. I can't really think of any other property types that have that same business model combined, sales and rentals. So it's very unique, and we can definitely dive deep into that if you'd like. But I would recommend that people at least research the property type to see if it's a good fit for them, because it is extremely profitable, and it's something that a lot of people aren't looking at, giving you maybe some opportunity to buy things that other people just aren't looking for, if that makes sense.
It does. So if someone wanted to talk to you about they've run into a mobile home, just an individual mobile home, and or they've seen two or three, how would you respond to them? What would you say? And they're like, "This is something that I want them to do."
Yeah, I mean, I would say there's definitely two different asset classes here, and I want to clarify that. We've got a mobile home, which is chattel. Okay, it's like a car. It's looked at like a car, and then you have a mobile home park. And a mobile home park is the real estate, the underlying real estate and infrastructure and common areas that hold the mobile homes. So if someone contacted me and said, "Hey, Mario, I've got one, two, or three mobile homes, I'm interested in doing something with these," I'd say it's probably much more similar to a single family model. Frankly, I would tell most people that if they want to just buy and rent out homes, they can probably make the same or better yield by buying a mobile home on an individual lot than they can on a stick built home, as you call them, because the basis in them is so much lower. A cost of a mobile home on a lot is typically the cost of the lot. A lot of times you can find a single mobile home on a lot, and the owner puts zero value on the mobile home, or very, very little. So now if you can collect close to that same rental income on the mobile home, 3-bedroom mobile home, as you could a 3-bedroom single family or apartment, you see how much higher cash flow and yield you can make off of that. So I would say there's nothing wrong with that business model. What I believe is superior when buying mobile home parks is you've got sale, right? And more importantly, we don't own the homes. So the residents own the homes and they have to maintain it, which keeps our expenses low, and it keeps our management, the operations and management of the property also lower too, because we don't have turnover costs. We don't have whenever a tenant moves out, we don't have downtime where we're not renting that unit. So there's a lot of benefits to it that attracted me to the property type.
That's interesting you mentioned that because when I would go to the auctions and there'd be like at Texas tax sale,
Yeah.
the actual lot was valued as if it were a single family home. And we couldn't understand. Now it makes sense because they're looking at the revenue or the potential it can generate. It would appear because it was the land. I mean, it wasn't
Yeah.
even really the actual mobile home itself. That's real interesting. So
Yeah.
so for our people that are attending the group and they're like, well, you know what? I would like to do single family, but that's just not my thing. I want to do something more in the commercial space. Would you recommend that they start there, or would you say single family and then transition? What would be your recommendation?
Yeah, great question. I think that a lot of times, for reasons you said at the beginning, we invest in things that we're familiar with, right? So we go, well, I lived in a single family home, or I lived in an apartment, I lived in a mobile home. And so we want to go and start out small with the thing that we're the most familiar with. If I could start all over again, I would skip over single family altogether. Okay. I would jump straight into commercial property. Even if it was smaller commercial property, I would still jump into commercial property. And let me tell you why. Because commercial property is valued different than single family. Single family is valued based on the comparable sales model, right? So when an appraiser or a broker does a valuation on it, what they're doing is they're running comps. They're checking to see what the other homes in the surrounding 1-3-5 mile radius are to determine what this home is worth. You can over improve that property. You can make it the sexiest single family home. And on top of that, you could rent it for $1 million a year, but it's still only worth max what the home down the street is worth. So the other way to value property is on a cash flow basis. And the way that works is the net operating income that that property produces determines the value of the property. So if I buy a commercial property and I max out the value or the amount of income or increase the amount of income, that means the value of the property goes up as well. You could have two identical mobile home parks, two identical apartment buildings, two identical retail buildings right next to each other, same size, same everything, but one's getting a higher NOI, that property's worth more. And so what I want to do is I want to buy assets that I can control the value, that I can force the value up on, and I can't do that with a single family. The max I can make it worth is what the comparables are for the most part. So
Yeah.
what I'm getting at is real wealth can be built with commercial property, especially when you got scale on those commercial properties. I would rather partner with someone, have a smaller ownership piece of a bigger deal than own 100% of a small deal. And that's because if you think about it on a percentage basis, if you increase the value of a single family home from let's say 10%, okay? If you increase the value of a single family home by 10%, what is that? That's $10,000 in increased value. If you're 100% owner of that, you just created $10,000 worth of equity. But if you buy a $2 million deal and you increase it by 10%, you just increase the value by 200,000. So even if you've got one other partner and you split in it 50-50, well, I just made $100,000, not $5,000. So scale matters. And I would always go larger versus smaller to start out. And we can dive deeper into that if you want.
No, I would, because when you say larger, you're talking about land size, right? Is that correct?
Well,
So you're talking about the land.
I'm talking units and I'm talking value.
Okay.
So what I mean by that is if I can buy a property with 100 tenants, some people would say, well, that's riskier than buying one with 2 tenants or 5 tenants or 10 tenants. I would disagree. The larger and the more diversified your income is across more tenants, the lower risk you're taking, the more diversification you have. So if I lose one tenant in a duplex, I'm now at 50% occupied. If I lose one tenant in a 100 lot community or a 100 unit apartment building, I'm at 99% occupancy. So I'm not going to feel losing the one tenant, or I'm going to be probably negative losing one tenant on a duplex. And so scale matters. And then also for value, the reason I say value, going as big as you can, is because lending actually gets easier the larger you go. People don't know that. They think, well, the bigger the deal, the harder to get it financed. It's not true. It's easier for me in many cases to finance a mobile home park worth $5 million, than it is for someone to go and finance a 5-unit apartment building or, 5-unit building. You might say, well, why is that? Well, it's because they look at it differently. A lender on the commercial side is going to look at, which is 5 units or more, is going to look at that property as a commercial asset, where they're going to look at a single family or a fourplex as a residential property. And when they do that residential, they look at the borrower and their ability to repay the debt personally much heavier than they look at the commercial asset. When they look at the commercial property, they look at, can this property support the debt service? Can it support the mortgage payment, not the individual? So I can go buy a deal for $5 million with less scrutiny and less headaches with the bank than I can a 4-unit, quad house, because they're looking at
So
it
I
from an
like that.
asset standpoint more.
Right. Well, I like that too. It plays into the recovery too, as well, right? So when you talked about it being on an individual basis, that's why a lot of people are really scared of investing, right? Because we think of it in the mindset of, if this doesn't work, that's my life savings, right? That's my livelihood that's out the window versus commercial, it's the business, right? How do you increase the value to the customer and then drive sales, right? Or drive occupancy, and then it's not like you said, it's not as harmful. So, but we're not taught that,
Right.
unfortunately. I think as we're migrating and evolving, that's why it's good to have people like you to teach people that, hey, actually this insulates you in a way, if you think
Yes.
about it, right?
Well, because
It does.
they're also, and I want to touch on something you just said, Joe. This is super good because typically in a small multifamily or residential loan, you're personally guaranteeing that debt. On larger commercial assets with institutional lenders, so typically $1 million loan or higher, you can often get institutional debt that's non-recourse, meaning you're not personally signing on the debt. Now, that doesn't mean we go do bad deals because we don't care if it fails. That's not it's not what I'm saying. But when we're talking about protecting our personal assets, taking lower levels of risk, things like that, you want to get to the non-recourse status, and really the best way to do that is to go larger, because that's where those lenders are.
And I'll just to let you know, I wish I would have done that too. So,
Wish I would have started
but
with it too.
it's the natural, transition. And when I was in the military, I was in the Air Force. We weren't really taught that. It was be conservative. So what's being conservative, right? It's the rental model. It's, just
Small.
do one, then transition to two. Don't hurt yourself,
Yeah,
9 to 5, which is completely opposite of why you're doing it, in my opinion. I mean, you hit the nail on the head. If you're trying to generate real revenue, and like you said, it's 2 million versus 200,000, or 5 million versus 500,000. Why in the world would you not insulate yourself and have larger upside? But we're not really taught that. And so,
right.
it's funny because I go back into my mind and I'm like, well, were there gentlemen like yourself 20 years ago? I'm sure there were, because right, there were mobile home parks.
Of course. Yeah, they've
But
been around for 70 years, 80 years, 70
right, but
years.
they didn't want to let it out of the bag, right? So that was really probably a small, real small percentage of the population.
Sure.
Obviously, you didn't have these forums and so forth, but man, I wish someone would have just taken me by the ear and said, "This is what you need to do." Kind of like what you're saying, because when you look at the numbers, it's just the zeros, right? And
Yes.
when you read books, that's exactly what they teach you. Is I like that marginal cost. As it goes down, like you were saying, is that you're insulating yourself and you're taking your risk, because really what we're doing is talking about risk mitigation. And so when
Absolutely.
you're mitigating your risk over that scale, it really helps you to, realize, what? I'm doing this wrong. I only have one, so that's all I have. So I can't lose it, you know?
Yes.
Versus if I have a
Yes.
hundred, it's like, okay, no problem. I can recover that.
Yeah, and your cash flow isn't affected. I always give this example. If you think about it, if I buy a 10 space community, all right, or you buy a 10 unit apartment building, I always want to translate this to whatever asset people are investing in. If you buy a 10 unit apartment building or 10 unit mobile home park and you have a plumbing break, okay, and it's underground and it's going to cost you $5,000, $4,000 to fix. The plumbing cost doesn't change because you've got 100 space community versus a 10 space community. The cost of that plumbing repair is going to cost the same. But which one feels it a lot more? You might wipe out all of your income for the month on that 10 unit apartment building, or 10 unit or 10 lot mobile home park. But yeah, you're not going to be excited about it on the 100 unit building or 100 lot park, but it's not going to wipe out your returns for the, you just got a lot more cushion, and a lot of those costs are fixed. It doesn't cost more to fix a plumbing break at a larger property than a smaller one. So you just feel the impact of those surprise expenses so much more. And that's why, a lot of times when people start buying, and I'm not knocking investing in single family homes, I feel like, and I believe flipping, trading, wholesaling models of single family homes is really the best model for a single unit, where a rental model is better for multifamily or multi-unit properties, generally speaking. But I forgot where I was going with that. The whole point is that if your expenses, you know, are the same, you're going to feel those expenses a lot more on the small properties. So don't get wiped. Oh, I know what I was saying. So sorry, I'm jumping around here. On the single family home, people think, well, man, I'm making $300 a month. I'm killing it on this single family home. That's $36,000 a year. And then in year 2, they have to replace their air conditioner for $5,800. How much money did
Mhm.
they make over those 2 years? Profit? Zero, right? They got
Right,
wiped
zero.
out. And then in 3 to 5 years later, their roof goes out and they got to put out. 9 grand to replace the roof. How much money did they really make when they figure in their long-term CapEx items that they weren't reserving for each month? And that's another lesson. If you're buying even single family homes and renting them, you should be setting aside CapEx reserves, capital improvement reserves, so that when you need the money, it's already set aside. You're not having to dip into your daily cash flow or your monthly cash flow to pay for it or write personal checks for it. But a lot of people don't calculate those long-term CapEx items that wipe out their returns, and they don't realize that they're actually making close to nothing but managing a single family home for 10 years. Yeah, you pay down the principal, but when you compare that to something that you can grow real value from, it's a no-brainer. Just from a learning standpoint, you're not going to find any good deals on LoopNet or Cracksea to buy, but the fact is if you look at real deals, you start to learn what you don't know and don't understand. So if you're looking at deals just for evaluation purposes and learning purposes, and there's this DSCR, debt service coverage ratio, noted in there, now you know, hey, wait a minute, I don't remember learning that. I need to go learn what that is. What does that mean? Because in real deal situations, you start to learn what you don't know you didn't know, right? So I would say jump into looking at real deals as early on in your learning as possible. And then from there, start making offers. And, I would also recommend someone who doesn't feel like they have the track record to go take down a larger deal or convince a seller sell partner with people. Use credibility of other people's success to bridge the gap, both with banks, with investors, with sellers. You can do that. Like, Joe's been in the game a long time. So if you're buying what Joe's buying and you're just getting, so you partnering with Joe on a deal means that you can utilize his credibility at the table. And now you guys buy the deal together. You learn, you make money, he makes money, and you get the deal done. So I wouldn't let lack of experience slow you down. You can utilize other people's experience to expedite your growth. And I always tell people to do that. Now, obviously, be careful with who you partner with. Joe's a good guy, but I'm talking in general. You need to make sure that you're vetting the people you're partnering with and making sure that it's going to be a good partner. But track record is important. That's how you get around that as well.
It's so
Yeah.
funny that you mentioned that. Is I think that it's partly because with the single family model, I think it's 100% or 0%. And so people are not used to joint venturing. I think
Yeah.
when you start talking about doing something with another person or learning from other people's experience, I think it's learned behavior over time,
Yeah.
because that's the one thing I'll always say is, I've never met a man or a woman ever go broke from making a profit, right? And that means
Yeah.
if you're collaborating together, right? But at the same
Yeah.
time, I think when you're saying that, it's not a large scale venture. So it's like, I need to keep that, $10,000 to myself. It's an
Yeah.
individual decision. So, I mean,
Sure.
I hear what you're saying. I think it's just a behavior that has to be broken
Yes.
as you scale, right? I think that's notable.
Yeah, commercial deals typically are larger, and they tend to be team sports. It tends to be a team sport. You tend to have specializations. Like, Joe might be really good at sourcing and negotiating deals, and I might be really good at raising capital and doing asset management or due diligence work. And so by us partnering together, it's like a business, right? Every asset we buy has different aspects to it. So number one, they're large enough to support multiple people in the deal financially, where it makes sense to partner with people, but they're also advanced enough and there's enough going on in that deal where having a couple, 2 to 3 people doing things that they're best at helps. You know what I mean? So it's definitely apples and oranges when you go from single family to a commercial asset, but it is a mind shift to go, I'm going to do this all myself, to wait a minute, I'm going to team up with other people. But it's worth it when you're getting started if that's holding you up from, you know, getting past not having a track record. Let me also point something out. I could go buy a $20 million building tomorrow and raise the money, okay, and hire a third party management company, and the bank would finance me. Why? Because they're not looking at me individually. They're looking at the business and they're looking at who's going to be managing it, which could be an experienced property management company. And so it's still that whole mindset shift from going from the local bank financing me on a single family home where they're just looking at you and your personal financials to this is a business you're buying and you can hire professionals to run it for you and the bank looks at it the same. So pretty cool.
That is cool. So what are some of the mistakes you could make? I mean, when
Yeah.
I'm starting this, I come to you, what would you tell me? What
Yeah,
should I
that's
not be doing?
great question. So, I think a lot of times what we do is we take that rental model that we're used to and familiar with, and then we bring it over into the mobile home park world. And we, well, this community has all of these rental homes in it. And so I'm just going to value the cash flow of those rentals the same way I do an apartment building or a single family. And there's really two different models in the mobile home park world. You've got a rental model, which is where the community owns all the homes and the tenants rent out the home and the lot, okay, from the community. And I look at that as kind of like a horizontal apartment building, right? It runs just like it. You have the same turnover costs, you have the same, you know, very similar business model and operations as an apartment building, just they're renting out mobile homes. Then you go over to the other model, which is a lot rent model, which is what I run. And that's where you own the dirt, the common area, the infrastructure, but you don't own the home. Here's the problem, they're valued differently. Okay. So the way mobile home parks are valued by sophisticated investors, appraisers, and lenders that understand the business is they value the cash flow from the lot rent. And then the value of the homes just comes from the shell value of the home. So what I mean by that is let's say lot rent, I'm going to make numbers really easy here. Let's say lot rent is 500 a month. And if you rent out the home and the lot, it's 1,000. Okay. Well, an unsophisticated, inexperienced investor in the mobile home park space would come in and go, okay, $1,000 a month times, let's say, 10 units. I'm just making this up. Well, that's $10,000 a month. And let's say there's an expense of half that. So we're at 50% expenses. So that means $5,000 NOI. And they go, well, cool. I'm going to put let's just make it numbers easy and say a 10% cap rate on that. Okay. Well, that would mean that the property is worth, that'd be like a $500,000 value.
500,000. Hmm.
So basically, if you're getting 1,000 times 10, that's $120,000 a year. Cut that in half, that's $60,000 NOI. Well, on a 10 cap, that property's worth $600,000. All right. But what they don't realize is that the bank, the appraiser, and any sophisticated investor in this space is going to look at that and go, no, no, no. The lot rent is 500. 500 times 10 is $5,000 a month. That's 60 grand a year. Cut that in half. You're at that's $30,000. The property is actually worth $300,000. Oh, and then yeah, we're going to add the value back of each home. Let's say the value of each home is $10,000. So really the property is worth, $400,000. I hope my numbers are right. It's late in the day, but basically the property is worth $400,000, not 600,000. But you see how you can make a huge mistake. And you might say, well, yeah, but the bank is going to tell me that it's not worth that, and so will the appraiser. Well, not really if you're doing seller financing. So a lot of times these sellers with park-owned home communities ask very high prices and they offer seller financing because it's very difficult to get those properties financed compared to the lot rent model communities. So they go, oh yeah, no problem. I'll carry you on the paper. You bring, 25%, 30%, 20%, whatever, put up your cash. I'll carry the paper on it. Now you own the thing and you don't even realize you're upside down by $200,000. And when you go to sell it or refinance it, then you find out what you actually own. And so that's the biggest mistake, is how people value them. You've got to value the lot rent, and then you value the shell value of the homes on top of that, not the income from the homes that are being rented. Okay. So that's how people can make a huge mistake, lose a lot of money, and wish they didn't buy it because they're stuck with it.
So is there restrictions on how old those actual units can be in some of those parks, is to protect you from the value, or is that not, does that not apply like RV parks?
Where I see, not as much. I do see some owners, especially in very affluent areas and, areas that demand much higher quality. Whenever somebody is going to sell their home, the community will buy the home, demo it, and bring in a brand new one to sell. That's on a pretty large scale, and that's very expensive to do. So most communities don't have any restriction on a home where they're going to force you to take the home out of the community, but there are some restrictions with the local governments in some places. Like we own communities in Marietta. I own something in Marietta, Florida, but Marietta, Georgia, where Cobb County will not allow homes that are older than 10 years old to be brought into the community. So there are restrictions on what can be brought into some counties, but I have never seen where a community says your home is 50 years old, you've got to pull it out. It just wouldn't make financial
Gotcha.
sense for the community or the resident.
But the replacement, though, they could say, okay, if you're going to replace it, yeah, you can't
Yes,
go buy an old,
communities.
you know,
Some
right.
communities will let you, and some counties will also let you. Municipalities will let you, but you just have to understand what you're buying, and where it's going. And then if you're smart, you go, or at least I shouldn't say smart, but you know what you're doing. You'll go pull the permit at the county to move that home in and set it up before you ever buy the home to make sure that it's going to be approved to be brought in and set up. And if there's any headaches or any red flags that pop up, it happens before you went and spent the money on the home. So it's a learning lesson if you don't know that up front.
So are
Excuse
there
me.
still properties to be had out there? Can you still buy viable mobile home parks? Are there still, do they still exist?
Yeah. What I love about mobile home parks is where we're at in that market, right? So every industry, and if you've heard me talk about this or about mobile home parks before, I probably mentioned this. The manufactured housing or mobile home park industry is consolidating right now. And that only happens one time in every industry. So if you think about it, self-storage went through this phase. It's still consolidating, but it's late stage, right? So a lot of the mom and pops who developed them over the years sold off to institutional and professional investors. Now you've got really sophisticated market. You've got a lot of data. You've got REITs in the space. You got a lot of institutional investors. It's a very efficient industry or a very efficient market, just like apartments. But mobile home parks are much earlier on in that most of the people who developed communities developed them with their bare hands. They built them, a long time ago. And many of those owners still own these communities, but they're getting up in age. Like you said, these communities might be around for 50, 60, 70 years. Well, if the community's 60 years old and you developed it, you're probably 80 something. So you're getting ready to retire and you're thinking about, passing assets on to your family. And so they're basically being pushed to the table to either pass it on to their heirs or to sell. And so there's this big transition from mom and pop long-term owners to professional owners. And so there's still deals to be done because a lot of these owners operated these communities like lifestyle businesses. So they develop them, they pay off their note on it over time, and then they own it free and clear. And they're really not worried about maximizing cash flow, maximizing value, because they're not looking at it on a return basis. They're looking at it on, does it pay for my vacations? Does it pay for my family's food and housing and all of that? Like, it's a lifestyle business for them. So they're not pushing it. And they're also not utilizing industry best practices to maximize because they're not thinking about asset value and equity. It's just income for them. And so then you get professionals coming in going, whoa, we can implement all these systems and procedures and efficiencies to make this property worth so much more because we understand how they're valued. And we come in and we implement all these systems. So you can basically buy assets from people who have not maximized the performance of the property and create value. Remember, we talked about in the beginning, these properties, any commercial property, for the cash flowing property, I should say, that's valued on a cash flow basis, the value can be forced up by increasing the income. So that's what we're looking for. We're looking for properties that owners have just kind of been in chill mode for a long time, haven't been reinvesting to improve the property, make it nice. They haven't been raising rents. They haven't been billing back utilities and a lot of these other strategies that increase the cash flow. And you can buy it. They're happy because they get their, big check that they were looking for to retire. And then we're happy because we can implement some things and create tons of equity in very predictable period of time.
So if I'm an individual and I come to you, are you going to pair me up with someone else who'd like to do it? Or is that case by case? If I had my own money to do it, so what would you recommend? What would you say?
Yeah, I mean, if somebody just came to me and said, "Hey, I'm a blank slate. What do I do?" I'm going to push them to my coaching and education company because that's what I do. I teach people how to buy mobile home parks. But with that, or even outside of that, I wouldn't necessarily push somebody to go invest with someone else. I would say if you want to go do it yourself, just be knowledgeable about it and go do it. If you want to partner, I would be interested in partnering with people, or sometimes the deals don't necessarily fit my buy box. So I'm happy to make introductions for people to partner up with others. Of course, they have to vet the others themselves. I'm not going to, back the person that I introduce, but you got to make those decisions for yourself. But ultimately, yeah, I mean, I think you can do it on your own. You can partner with someone who's got a lot of experience. So you could also partner with a newer person that just has a different set of skills. One thing that I see a lot of people do in general business is partner with people that they like. And why do they like those people? Well, it's usually because they're similar, right? Joe and I like to talk shop. We like to talk mobile home parks. We're, both outgoing. We're great with people. We like negotiating. We like sourcing deals. So we go, man, we should really partner up and do deals together. That would be fun, right? Well, of course, because Joe and I like each other. But as soon as we go into business together, Joe and I start to butt heads 6 months down the road because why? We're both good at the same thing, and neither one of us is good at the other things that need to get done. So we're both trying to do the thing that we're good at, and nobody's doing the thing that we're not good at. And now we got two people sitting in one seat and nobody sitting in the other seat. So we start getting into disputes, and those partnerships fall apart, not because they weren't good people, didn't like each other. It's because they were poorly aligned in their skills. If I'm good at acquisitions, I want to go find somebody who's really good at underwriting or property management or things that are opposite of my skill set. I want to like the person that I do business with, but liking them is less important, than the skills and how they complement each other. So I would say if you're just a lone ranger, you're like, you know what, I don't want partners, totally fine. You don't have to. You just have to have more skills then to cover all bases that are needed in these transactions.
Right, which is tough, right? Is because, it's kind of like the whole getting hired adage is, yeah, hire me, but when you're like, well, you don't have the skills. Well, then how do I get the skills, right?
Mm-hmm.
So to your point
Yeah.
is it's joint venturing with someone who does to start, and then
Yeah.
absolutely taking that. Would you and then getting good at it. So would you say that most of the parks that you see are individually owned, like from, like you said, generational legacy? So right now, as we sit, are most of the parks owned by just a couple of people, or mom and pop, or
Yeah.
have you seen a
I see what you're
transition
saying.
to companies?
Yeah, it's transitioning, but there's about 44,000 roughly mobile home parks nationally, which isn't a lot. Sounds like a lot, but it's really not a lot. 44,000 communities nationally, and a good amount of those are still owned. And I don't have the exact number, so I don't want to say, I don't even want to speculate on a percentage, but a good amount of those are still owned by individual small partnerships and sometimes even the original developer of that community. So when I'm calling owners and talking to them, a lot of the owners are just mom and pop people. And even if they're not a mom and pop in the sense like they're old school in their ways, a lot of them are just like individual guys like you and I that got in, bought one, maybe two mobile home parks, and that's all they cared about, and that's totally fine. Sometimes they're sophisticated and understand the business model well. And then sometimes they just had a 1031 exchange come up and a mobile home park fell in their laps and they say, yeah, this looks kind of like an apartment building. I'll buy that, and they just bought it and they really don't know how to maximize it. So they still leave a lot on the table for you when you buy it from them. I mean, one thing that I'll say is that there are quite a few owners that have bought mobile home parks over the last, call it 3 to 4 years, that came from the apartment space, because apartments were so aggressive. You know, it was just so competitive for so long that people couldn't find deals that made any sense. So they started going, well, what else produces cash flow that's similar to an apartment building? And they went from apartments to mobile home parks without a lot of education, thinking it was going to be very, very similar. And then they get a rude awakening that, wait a minute, this is a whole different beast. Like, I thought this was going to be easier to manage. I thought this was going to be just renting out dirt, no problem. Well, yeah, it's less management intense, but it's different. And so I've even bought a park from a guy who did that. He bought it and came from the apartment space and was like, you know what? I'm going back to the apartments. I already figured out I don't know what I'm doing. And he, within a year, sold it. So we have seen a good number of those as well, because people assume that by reading some, posts on Bigger Pockets and listening to a few podcasts, that they can go out and just, switch gears and run that property just as good as they ran another property. So it is, and I'm not trying to make this like a pitch fest or anything. It just really is important to get educated and understand, when you're buying super valuable assets, how to manage those and run them right, or you could lose money too. So, but you can make a ton of money. So if you're going to make, hundreds of thousands or millions of dollars on one deal, it makes sense to learn the right way to do it.
Right. So that leads me into asking you, so how do we find out more about your training and how would we get involved with that?
So I've got a course and a coaching program all combined, and it's called Real Cash Flow. And people can check it out at getrealcashflow.com. You can watch video about what I do there, and we've even got on-site visits. We call them on-site shadow, where students of mine can actually come out on a property when I'm either doing due diligence on one that I'm buying, or if I'm visiting one of the communities I already own. They spend a whole day with me, and it's not like a tour. I'm not walking around teaching them. I'm actually doing what I'm doing that day, and I'm handing them a clipboard. They're getting involved. They're doing it with me because I'm actually there working, and they get a real life experience of operating or buying one of these communities, and they see it in action. They see my team out there. We're all working together, and it's pretty awesome. So that's one thing that some of my students choose to take advantage of as well. But I would say check it out, getrealcashflow.com. And you can also just follow me on Instagram. I'm putting out a ton of free content all the time. It's just Mario Dattilo TV is my handle on there. And I'm putting out a ton of free content. It would get you the basics. I've also got a YouTube channel, mariodattilo.tv, and you can get the basics of mobile home park investing. And if you see that, you're like, wow, that looks interesting. I can do what he's talking about in those shorts or in those 5-minute videos. Then go over to getrealcashflow.com and see the bigger picture and how to actually get hands-on help, where you're not just trying to figure it out yourself. But yeah, I'm happy to help anybody, and would love to just see people be successful, whether it's in mobile home parks or others. So hopefully this content is going to help everybody, no matter what asset class they're going to pursue.
Well, I absolutely think it will. I was mentioning to you that I kind of revamped my whole group itself to mimic a wealth management company. And one of those opportunity circles is called revenue. And under revenue, obviously, are real estate type classes that generate revenue, but you have to have real estate to do the business well. I mean, to actually have it operate. I
Right.
think this is one of and it's always, man, I'm like, God, I'm so late. Why didn't I think about this? Where were you 20 years ago?
Yeah.
Where were you, man? I'd be done. It'd be sand, right? I'd just be dumping
Yes.
sand in the middle of that mobile home park. And I'd be like, I'm on vacation. Dang it. But I think this is actually one of the ways a lot of people can get involved in real estate and have a business, right? Because it's a business. I mean,
Yes.
that's what we want to echo is, a lot of people think, oh, I own that piece of real estate, but it's got to operate. There's
Yes.
operations. And so that's what I hear you saying is, yeah, it's real estate, it's under that umbrella, but really think about it in NOI. And anytime you see net operating income
Keyword is
is
operating. Yeah. Well,
correct,
actually, that's a
right?
really good point, Joe. That's a really good point. Let me pause you on that really quick. There was a post yesterday that I saw somebody did on Facebook or Instagram, whatever. I think it was Facebook. And he said, why would anyone invest in a syndication as an LP, a limited partner, meaning be a passive investor with no control management or voting, versus just going out and buying a single family home for investment? And the answer is, well, because it's apples and oranges. You're saying, why would somebody invest passively when they could go invest actively? Well, that's obvious. If you want to be a passive investor, then you need to invest passively with an active investor. If you want to invest actively, then yes, you're going to go buy that asset directly and be the operator of it. But no matter what, even single family home rentals are not a passive income. It's a business. Even if you have one or two, somebody
Right.
has to manage it. And so I think what you just said is crucial. If you want to have passive investments in real estate, you've got to invest with active people. If you don't mind being active, you make more money because you're making all the returns, and obviously you're running it, so you're not giving somebody else part of the deal or paying somebody else to run it for you. But there's options there. And if someone says, I really don't want to be an active person, I don't want to run a business in real estate, then they should be looking at limited partnership opportunities to invest with experienced operators who are out there running these type of properties, or any kind of property for that matter, and invest on a limited basis, so that the only risk that they have is their capital invested. They're not making, they're not involved in management. They have limited downside risk and a lot of potential upside with experienced people who know what they do and do it all day, every day as a business.
Right. And I agree with you. I mean, typically I get asked two questions, right? Is one, if I invest with you, how do I not lose my money? Right. That's the first thing I want to know, which really translates to experience. So, what is your experience when we're talking about these different types of real estate? What have you done? I want to see. Let me talk to someone. That's really what a testimonial is, right? So,
Yep.
okay. So now I'm convinced that you won't lose my money, or you can't guarantee it, but
They're a
you've proven
trustworthy
to me that you can
individual.
do
Yeah.
this, right? The second question is now, how do you make me money, right? So there's just those two questions. And so I think what you're saying is, what we've got out of this is, you've developed this strategy, you've done this strategy, you've developed the experience, right? So now my risk, right? We're talking about risk mitigation. You've mitigated a lot of those questions. Now it's, how do you make me money? So I
Yeah.
think in this revenue model, type asset class that I'm calling it, and that's one of the reasons why we wanted to reach out to you, because once we develop those opportunities, we want to reach out to people like yourself, and to start working with people like yourself to grow, and develop awareness. Because, like I said, where were
Yes.
you 20 years ago, man? Were you like in junior high, or I don't know what you were
Something
doing?
like that.
There,
Yeah.
something like
It's
that. Yeah, I
graduating
know.
high school.
I'm, I'm a little older than you. So,
Yeah.
but it was always such a foreign concept. And I know you're probably, because you're immersed in it, but I think revenue generating models that include real estate are foreign in nature to most people, because we call it, the real estate that's in the windshield, right? And what that is, you're driving by all these different things every single day, probably to go get your ice cream or your milk. You're
Yeah.
driving by it. You don't think twice about it until, I mean, usually it's one of your family members living in the park,
Yeah.
or buying the actual product, which is the RV, and then using the park. But you're very rarely thinking that you could be the owner, or someone that actually plays a role in receiving the benefit from it.
Yeah, they don't see the
So that's why
business behind it. They just see the storefront. They just don't understand how it works, so they don't think about it. Let me give something to everybody, regardless of what you're investing in. Okay, this could be an entrepreneur, this could be a real estate investor. This was like an epiphany for me about a week ago. I went and spoke at a mastermind in Colorado. another guy put it on. Chris Rude, you might know who he is. He had a great mastermind, and I was out hiking with two other entrepreneurs, and in the morning, and one of the guys was relatively new, and he said, I have been, in the oil business, an oil worker for all these years. And I knew that there were entrepreneurs out there, but I never knew there were these groups of entrepreneurs that came together and did masterminds and other things like that. And as I'm listening to him talking, I'm going, really? I thought everybody knew about masterminds. Shoot, every time I go on Instagram, all I see is entrepreneurs and real estate investors. Every time I am involved in any sort of group, I'm all around real estate investors and entrepreneurs. So what do you mean you didn't know that these existed? And then it hit me. The reason I don't the reason that I didn't know that or didn't realize that is because I've been in it for so long. And that's not me bragging. That's saying, for you as a new entrepreneur or a new investor, the best thing that you can do is immerse yourself in groups like what Joe's got. Get around people, make all of your friends entrepreneurs and real estate investors, make everybody that you're involved in your circle entrepreneurs and real estate investors, and then it just becomes normal and it elevates you mentally in the world that you're in. And I looked around, I'm like, holy crap, everybody I know and talk to on a daily basis is an entrepreneur or a real estate investor, but it's because I've immersed myself into these kind of groups like what Joe's got, Joe has, and that will expand your learning, that will expand your opportunities and all of that. So no matter where you're at, just start immersing yourself in as many groups, in as much education as you possibly can, and those relationships with people who are doing what you want to do, and it'll just become your absolute norm.
I agree with you. I mean, I tell people all the time, I started this group to generally help people, but what ended up happening is I just got a PhD in this stuff because
Yeah.
people like yourself, I mean, I just started learning, right? Because when you listen to it over and over and over again, and the aspects of real estate I wasn't really even interested in, and I go, oh, wow, I didn't know that. With
Yeah.
land, the different strategies that you can just pick up just by developing relationships with people. So, I know you have on a tight schedule. So, Mario, we are definitely going to do this again. I mean, I
We
can't
will.
tell you how much I'm thankful for you spending your time with us. We want to collaborate with you here in the DFW market.
It's going to be fun, especially because I own assets in Dallas. So I want to be a part of the family. So thank you so much again for having me on, and God bless you. Thank you.
That's great. And again, we are at the Dallas Real Estate Investment Group, and that's dallasreig.com. And so you'll be finding more about this asset class as well as many others that we have, because we genuinely think that you should get educated about the real estate environment. And when you do have an asset class like this one, we will actually have the resources for you to transition and to start doing that with a subject matter expert like Mario. So thanks everyone for tuning in, and we will see you next.